Welcome to this lecture on news trading and market sentiment analysis. In this session, we will explore how market-moving news impacts asset prices and creates opportunities for traders. By developing the ability to interpret and act on news efficiently, traders can enhance their decision-making process. By the end of this lecture, you'll have a clearer understanding of how to incorporate news analysis into your trading strategy. News events have a significant impact on stock prices, creating opportunities and risks for traders. Positive news, such as strong earnings, product launches, or mergers, often leads to stock price increases. On the other hand, negative news, like weak earnings, scandals, or geopolitical conflicts, can drive prices down. Uncertainty caused by unexpected events like interest rate changes or political instability tends to increase market volatility. Trading strategies based on news and market sentiment can help traders anticipate price movements before major events. One effective approach is pre-news trading, which focuses on predictable events like earnings reports, central bank decisions, and policy changes. Traders can research analysts' expectations from sources like Bloomberg and Reuters to gauge market sentiment before a report is released. Additionally, monitoring unusual options activity, such as high call or put volume, can provide insights into institutional positioning. Analyzing historical price reactions is a key strategy for traders looking to anticipate market moves. By studying how a stock has reacted to past earnings reports or Fed meetings, traders can identify patterns and potential opportunities. For example, if Apple, AAPL, typically gains 3 to 5% after strong earnings, buying before the announcement could be a profitable setup. A structured trade plan includes entering positions a few days before earnings and setting a stop loss to manage risk. Post-news trading is a reaction strategy that helps traders capitalize on sudden news events, such as economic data releases, interest rate decisions, or company announcements. When news breaks, stocks often experience an initial price shock followed by a pullback, so traders should wait for confirmation before entering a trade. A key technique is the 15-minute rule, where traders observe price action for 15 minutes after a major event to see if the trend holds. If the price stabilizes and resumes its direction, traders can enter a position with more confidence. This approach helps traders avoid impulsive trades and take advantage of market reactions strategically. Using technical levels for entry and exit is a crucial part of post-news trading. When a stock breaks above a key resistance level, it signals strength, presenting a buying opportunity, while a drop below support may indicate further downside, making it a potential short trade. For example, if the Federal Reserve announces a surprise rate cut, markets may react with volatility, and traders can look for key support levels to identify potential entry points. In this scenario, if the S&P 500 SPY drops but finds support at a technical level, traders can enter a long position once the price stabilizes and starts reversing. Effective risk management, such as setting stop losses below the intraday low and targeting previous resistance, helps traders manage their trades efficiently. Sentiment-based trading focuses on market psychology, using trader sentiment, social media trends, and news coverage to identify opportunities. Traders can monitor fear and greed indicators, such as the CNN Fear and Greed Index and the VIX, to assess market sentiment. Extreme fear may signal a buying opportunity, while high volatility levels suggest uncertainty. Additionally, tracking trending stocks on social media can help traders spot short-term momentum plays driven by retail activity. AI-driven sentiment tools can analyze news articles and earnings reports to determine whether the market sentiment is bullish or bearish. By incorporating sentiment analysis, traders can gain an edge in understanding how emotions drive market movements. Following insider and institutional activity can provide valuable insights for traders looking to capitalize on sentiment-driven moves. When company executives buy their own stock, it signals confidence and can be a strong bullish indicator. Additionally, stocks with high short interest, such as GameStop, GME, can experience explosive rallies if short squeezes occur. A prime example is Tesla, TSLA, where strong media coverage and retail trader discussions on social platforms can drive momentum. Traders can enter such trades for short-term gains, but managing risk by exiting when volume fades or price action weakens is essential. Tesla, TSLA, is a highly volatile stock that often reacts sharply to earnings reports, creating trading opportunities. In Q4 2022, despite reporting stronger than expected earnings, cautious guidance from CEO Elon Musk triggered an initial sell-off. Traders who anticipated high volatility based on analyst expectations and options activity could have prepared for a post-earnings reaction. The strategy involved waiting for the knee-jerk drop, identifying support around the 50-day moving average, and entering a long position as the price stabilized. Tesla initially dropped after earnings but rebounded over the next 3 days, gaining 8% as traders shifted focus to earnings strength rather than short-term guidance. This case highlights how stocks often overreact to earnings reports, making it essential for traders to wait for price stability before entering a trade. Utilizing support and resistance levels, along with moving averages, can help identify strong entry points. Additionally, when implied volatility is high, traders can consider option strategies like selling puts or using spreads to capitalize on market movement. In March 2023, the Federal Reserve's unexpected interest rate hike of 0.25% caused an initial market drop, but traders quickly adjusted after Jerome Powell signaled a potential slowdown in future hikes. This case highlights how divergence between Fed expectations and market pricing can create volatility. A key strategy involves pre-meeting analysis, identifying potential market reactions, and using options strategies like straddles to profit from uncertainty. After the decision, the S&P 500 (SPY) initially fell but found support at the 200-day moving average, presenting a buying opportunity. Traders who waited for stabilization and entered at support with proper risk management could capitalize on the rebound. Following the Federal Reserve's interest rate decision, the market initially dropped but rebounded strongly, rallying 2.5% within 48 hours as traders shifted focus to Powell's dovish tone rather than the rate hike itself. This case highlights the extreme volatility that Fed meetings can create, offering both risks and opportunities. Traders should wait for confirmation before acting, as the first move is often a fake-out. Using options or identifying key support levels can help navigate these volatile reactions effectively. Additionally, monitoring bond and currency movements can provide early clues about potential stock market direction. In January 2021, GameStop, GME, became the focal point of a retail-driven short squeeze fueled by traders from Wall Street bets. The stock surged over 1,000% in days, forcing hedge funds to cover short positions. Key indicators of the squeeze included extremely high short interest, unusual call option volume, and a sharp increase in social media buzz. Traders who recognized these signals could have capitalized on the momentum by entering early above resistance and exiting in phases as prices surged. Using a trailing stop strategy would have helped protect gains while riding the trend effectively. GameStop, GME, reached an astonishing peak of $483, creating massive profit opportunities for sentiment-driven traders. This case highlights how social media sentiment can push stocks into parabolic moves, making short squeezes highly profitable but also extremely volatile. Traders should watch for key indicators like short interest above 50% and unusual spikes in options volume as potential signals. However, having a clear exit plan is crucial, as parabolic moves often collapse just as quickly as they rise. The Non-Farm Payrolls (NFP) report is a major economic release that significantly impacts stocks, forex, and commodities. Traders can prepare by analyzing expected job growth versus actual data, as stronger employment numbers signal economic strength, while weaker data can be bearish. A breakout strategy involves identifying key support and resistance levels before the report and waiting for a price reaction. If price breaks above resistance, traders can buy the breakout, while a drop below support signals a shorting opportunity. Using tools like ATR, average true range, helps set effective stop-loss levels and targets to manage risk. The March 2024 Non-Farm Payrolls (NFP) report showed stronger than expected job growth, with 350K jobs added versus the expected 250K, leading to a bullish reaction in the stock market. The S&P 500 broke above key resistance at 4,300, triggering a buy signal, and the market rallied 1.5% within 2 hours. This case highlights the importance of trading breakouts rather than guessing market direction before the report. Traders should wait for volatility to settle and confirm price movement before entering a position. Additionally, monitoring bond yields and USD reactions can provide further confirmation of market sentiment. Effective risk management is essential for traders navigating news-driven volatility. Using stop-loss orders helps protect trades from sudden market swings, especially around key technical levels. It's also crucial to avoid trading immediately after a news release, as initial spikes and fake moves can lead to losses. Waiting for trend confirmation improves accuracy. Combining news with technical analysis ensures that traders make informed entry and exit decisions rather than reacting impulsively. Additionally, monitoring institutional activity and keeping an economic calendar helps traders anticipate major market-moving events and position themselves. News trading and sentiment analysis are powerful tools that help traders navigate fundamental market movements. By anticipating major announcements and reacting wisely to market-moving news, traders can position themselves for profitable opportunities. Analyzing sentiment allows traders to understand shifts in market behavior and make well-informed decisions. However, success in news trading requires a combination of research, patience, and strong risk management.